we've been so focused on the macro with what the Fed is going to do, with what's happening with Brexit, with China devaluing their currency, with the price of oil and all the FX moves, that we have really taken our eye off the fact that maybe the earnings are okay. And ultimately, it's earnings growth that's going to drive stock prices.
Is that what you believe?
Yeah, absolutely. We're fundamental investors, and you're seeing it particularly in the financials. I mean, the financials got a little bit of a rally, or have had a rally, because of the perception on the change in interest rates to a higher level, and that has pushed that group higher. But all the banks came in so much better than expectations. All their capital ratios are significantly stronger, and their balance sheets are probably the best post-World War II. So you're seeing now the fundamentals come through even without the step up in interest rates. So it's time to focus back on fundamentals.
Okay, so if you're talking about the earnings overall, as we've been talking about, most of the companies, the majority of the companies that have reported so far have actually beat, albeit lowered, expectations. Do you expect this to continue throughout the rest of earnings season?
Yes, I do. The one sector where you're probably going to see a continued struggle has been on the industrials. I mean, look at GE and Honeywell and Triple M. I mean, those companies that have a big exposure overseas are facing foreign exchange headwinds still, and their exposure to a slowing global economy outside the U.S. I would also expect trouble for utility stocks. I mean, expectations for the utility stocks were so high because they produce such big dividends that investors looking for income have bid up that sector very high. But the earnings fundamentals have not been strong, and I don't expect them to be strong in the utility sector. So expect more weakness there.